welcome back. We were in our studio before, but now we're in our office. So you may hear a few noises, a few cars and a few horns and who knows what going past. But one of the things that we do actually get asked a lot is, how am I best to buy this property? If I was to buy it in my super fund, or if I was to buy an investment property, what's the best way to do it? Now, as you can appreciate, as real estate agents, we're not in a position to answer those questions. So we always like to pass over to obviously accountants. And in our case, we'd like to introduce our great friend Steve Duckett from Super Accountants, who's going to be here to answer a few questions today. So Steve, welcome along, and thanks for coming into our office today to have a chat about accounting and what it's like when someone buys a new investment property of some sort. We normally say go see an accountant. So there's a few different ways to buy properties nowadays. Some people are talking about buying them in super. Maybe we can just sort of cover a bit of that as well. But usually when they sort of say, look, I'm buying an investment property, and we say go and see your accountant, what are sort of things that the customers ask you when they come to see you about, I'm thinking about buying a property, Steve, what do you think we should do?
Paul, firstly, thanks for having me today. Thanks very much. Buying a property, firstly, you've probably got to choose whether it's for your main residence or for investment purposes. Mm-hmm. I'm not sure which path you want to go down first, but affordability is one of the key aspects to look at. And having a deposit or sufficient equity in another property is a good starting point. The magic number generally is around having a deposit of 20%, mm-hmm. and any less than that, you will find yourself with having to pay lender's mortgage insurance, commonly referred to as LMI. And LMI can be quite costly, and then it becomes a trade-off as to how badly you'd like the property versus how much you want to pay in additional fees to have that property.
Yeah. Lender's mortgage insurance is something that we actually find that when we talk about that to our clients, they seem to think it's an insurance policy that insures them, but we find that it's not. You probably get the same sort of question of, well, I'm insured, but in actual fact, you're not insured, are you?
No, it's actually insuring the lender, so that should the loan go bad, they're protected, and you won't be any different. It's a cost. Yeah. It's an additional cost for you to purchase the property.
So should the client buy an investment property and then they default on their mortgage and for whatever reason they lose their job and they can't pay it, it doesn't protect them in any way. It's actually protecting the mortgagee, the mortgagor, the broker, the bank or the building society or whoever it might be, and it covers their loan.
Correct.
But they will still pursue the customer for the money, won't they?
If there was any shortfall, there
if
was.
If there's a shortfall,
correct.
Yeah. So it's really important to get that clear. But lender's mortgage insurance, and I think that's great advice from Steve. That 20% is the magic number. So you'd have the customers come to you and they would sort of say, look, okay, well, here's my tax situation. What do you think I should do? And where do we go from there?
Well, the taxation point of view, that's an interesting one. There's certain items that are. There's misconception that when they buy the property that everything's all of a sudden tax deductible, which isn't often the case. On purchasing the property, as per the settlement statement, there are certain costs that you will incur, being the main one being stamp duty, which is in the thousands, and the settlement agent fee, which is around the same, about $1,000 work on that. So those costs and the stamp duty will depend on the value of the property, but they are not tax deductible. In the year of acquisition. They're actually what we refer to as a capital item, and they're used as a cost base of the property for calculating capital gains tax or losses when the property is actually sold.
Yes. Yeah. So with the with that, some owners think they, as you say, can claim everything, but some of those items you can only claim when you sell the property, maybe many years down the track.
Correct.
Yep. Okay.
Yes.
Okay. So some of the questions that we get asked when we have a client and they're saying, that looks like a great property, I wouldn't mind buying it, but it needs a little bit of work, it needs some painting, it needs some repairs. I'd like to do that before I actually put a tenant in. What do you find is the situation from a tax point of view with that? They can't claim it straight away, can they?
That's a good question, Paul. Technically, no. There's some case law on this, and I'm not sure if there's one relating to property, but there is one relating to other assets, in that when you acquire a property at a discounted price, because it's in need of repair, the cost of the improvement and the repair to put that property back to its supposed original state can be viewed as capital, being depreciable and not deductible in the year of incurring the expense.
Okay. When you say at a discounted rate, so how does someone establish what a discounted rate is on a property?
I suppose if the property was in disrepair and it was obvious that there was significant repairs needed to put that property back into use, you would probably consider it to be at a discounted rate. The example there would be a motor vehicle, not talking property, but a motor vehicle that's engine wasn't working. You would have to correct the engine and fix the engine for it to be able to be driven. Yes.
Okay, so the person goes and buys the property, then they go and let's say the kitchen's in disrepair, and they put a new kitchen in and they paint the walls and retile it, a bit of plumbing and so on. So would they claim that in that first year, or would that be a depreciable item over a period of time?
It comes to the cost of the expense, but generally, with your question there, it would be depreciable. Painting can write off in the first year. Okay. Kitchen capital items, cupboards, etc., bench tops, ovens, cooktops are depreciable items.
Okay, so what you're really saying there, Steve, is there's some things that you can write off and some things you can't, but you can overall, but some of them are long term and some of them more immediate.
Yeah, so you still get the deduction. It's just that with the larger items, you spread the expense over a number of years rather than achieving that expense and write off all in the 1 year.
Okay. Would it be handy if clients actually, when they came and saw you before they even went out looking for property, is to go out there and have a chat with you first, or their accountant, and have a chat to their accountant, and then establish what their situation is from a tax perspective and their knowledge, I suppose. The accountants can give some great valuable knowledge before they buy a property. And then when they do put an offer in on a property, is then come back to an accountant or come back to yourself in your case of clients that are dealing down here. And then actually talk to you about, hey, look, Steve, I've put an offer in on this property. Here's some of the things I'm thinking about doing, and then you can just re-advise them on what's wise and what's not wise to do to gain the best benefits?
Yeah, I think so, Paul. Education would be the biggest thing that I could push forward here, in that so that client is going into the transaction informed, knowing what they can and can't do, as opposed to going ahead without having any consultation and having a different expectation of what the reality actually may be. So that would be I don't think you have to get into particular detail. You can talk generally about it to the client and just let them know that some things will be deductible, some things won't be, and so that informed decisions are made by the client. The other is when you're signing the offer, it never hurts to make it subject to finance with your nominated lender. That way, at least you have an exit out of the transaction if you're unable to get finance, as opposed to a cash offer where you could be held to follow through.
Yeah, okay. All right. Now, the banks nowadays, there's so many different interest rates around, and not that I profess or any of us profess to be, specialised in this area as such, but, there's a lot of offers out there at the moment. And I noticed with some banks, they'll say with interest, 100% offset accounts, that are interest bearing, and others that don't say that at all. And, I suppose there's some bare bones ones you could say. What's the benefits of having something like a 100% offset account attached to a mortgage that's used for an investment property?
An offset account I would probably use against what I consider non-deductible debt, being your main residence, before I would use it against tax-deductible debt, which would be your investment property. Offset account works in the fashion that you have a loan for, I'll use $300,000 as an example, of which you're making principal and interest repayments against, and you might have $20,000 in the bank. If the $20,000 was in an offset account, the repayments each month would be the same on the $300,000. However, the interest on that repayment is reduced so that the interest is calculated on $280,000, being the loan of $300,000 minus the money in the bank. So you're actually paying off more principal with each repayment and less interest.
Wow, and that's a great way to pay off a property a lot faster.
It can be if you have sufficient funds in the bank. Sometimes the interest rate is slightly adjusted to reflect the different perks of the product, but definitely worthwhile if you are an accumulator and you have cash at bank.
So would it be wise then for a couple to put all their income into that offset account every week or every month, and any extra savings they get, Christmas money or whatever it might be, just plonk it in there? So the more money in that offset account, really effectively what you're saying is offsetting the actual main loan that you originally had.
Yes, with interest rates being quite low at the moment, around the 3.5%, and then interest on term deposit even less. Effectively, if you have your monies in a offset account, you're contraring a 3.5% interest rate.
Okay. Wow.
Tax-free, so there's no interest charges and interest reduction.
Excellent. Well, I think that's some great advice that is out there for everybody to keep in mind when it comes to buying a property. Now, Steve, at Super Accountants, you actually also obviously look after super funds. That's hence part of the name of the company, Super Accountants.
Correct.
Do you find a lot of people are now saying, should I put this in my super fund when I buy this property? Should I actually put it in there as an investment in the fund? What are some of the pros and cons around that?
Affordability would be the main pro for this poll, where your super fund does have cash and it does have regular contributions going in, where clients do not have sufficient means outside of their fund. The super fund becomes that vehicle whereby it creates possibility. It's not easy, it's not clear cut, but it becomes possible.
Okay. Yeah, we find when clients come to us and say, I'm going to buy it in my super fund, one of the pieces of advice we give is that you need to go back and check with your accountant on what name to put the purchase in. And invariably, that's an area that's fraught in danger, really, because if they get it wrong, it can amount to, is it double stamp duty?
It can do. There's self-managed super funds is quite a complex area from the accounting and legal side of things. If the fund is borrowing money to buy the property, there is a requirement for a second trust deed called a Baird trust deed, and another corporate trustee for that deed. The borrowings are in the name of the new deed and corporate trustee.
It certainly sounds like an area that needs a lot of thought to go behind it, because I mean, with superannuation, it's really an asset, or it's a vehicle to actually grow your assets for when you retire. And you need to get that right. So I imagine taking out loans and so on associated with your super is that the risk of you retiring with loans at the end of the day, which would be pretty scary when you get to 65 and find that in actual fact you've got these investment properties or this commercial property, but there's this massive big loan on it. You'd probably have to sell something to actually pay out that loan or you'd have to extinguish the loan, wouldn't you?
Yeah, you've got to be able to demonstrate to the lenders that you have the capacity still to service the loans. The lenders lending to self-managed superannuation funds has definitely diminished. There's not a lot of lenders providing loans to self-managed super funds. There are a couple. The interest rate is marginally higher than the normal mum and dad outside a superannuation loan. And there is a requirement that banks generally will like to see your employer contributions going into the fund, and they'll also expect you to hold a minimum balance within the fund as for cash flow purposes to get you through any unexpected surprises.
Absolutely, because I can imagine that someone might have an investment property inside their super. Whilst that property becomes vacant when a tenant vacates, there's going to be a loss of rent, so therefore there's going to be repayments, and you can't just rely on, you can't just keep putting money in, I dare say, just to top it up, because there's a minimum of how much you can actually put into your fund every year, is that right?
Yeah, and this is where it becomes complicated, Paul. You're probably not in fear of reaching that minimum by contributing to your fund, but what many don't realise that with self-managed funds is that once you put the money in, it's not yours, it belongs to the superannuation fund, and there are rules by law that limit how you can access those funds.
So Steve, that sounds like it's one of those things that really takes a lot of thought behind it and a lot of work with your accountant to get it right before you even go down the track and start putting offers in and putting pen to paper.
Self-managed super funds are definitely one thing that you should talk to is your accountant before you proceed.
Okay, so moving on. So what we've covered so far is we've covered some thoughts behind somebody buying their first investment property and possibly even considering putting it in a super. What about the typical scenario where the young couples nowadays are thinking about we're moving out of home, we're going to go and get a flat, and boyfriend girlfriend, they'll live together and they'll start saving for a property, their first deposit. What sort of advice could we maybe give them from, obviously an accounting point of view? What sort of thoughts have you got there?
Well, you've got a legal issue to start with. If they're entering a de facto relationship, is one bringing more in than the other party? And if they are, be prepared to share that with the other party should things change down the track.
Yeah, that's a good point. Yeah, I suppose that once they join together and they join their funds together for a deposit, pretty much it's 50-50 in some respects, isn't it?
Generally speaking, I think that's fair comment.
So if they were to split, obviously the funds are going to go both ways, or if they bought the property, obviously there's going to be an issue too. But to get to the point where they actually have enough, that 20%, that magic number, to actually buy the property, what sort of budget or tips or suggestions would you suggest to a young couple today that they might put in place to reach that common goal they want to get of the 20%?
I think you've got to set yourself. They'll have to set themselves a budget and abide by it, and assess how achievable that budget is as time goes on, month by month, half year, 12 months, and see how much they can actually save.
Okay, so the cost of living, obviously they need to look at their costs of living, look at their luxury expenses, and then look at their money left over that they can put towards the saving of the 20%. Yes. Do you find that there's a degree of, when you see people's accounts, that there's a degree of wastage there that maybe occurs on a day-to-day, month-to-month sort of basis?
From professionally, Paul, I don't so much get to see that. It's a lot of compliance involved, but looking at the way we do spend, I think that is fair comment.
Yeah. Okay, that's excellent. All right, so we've covered a lot of information today. We really have got into the nitty-gritties of some of those topics there. Well, I was just about to wrap up the show just a minute ago, but I've just had a last thought, and I've got Steve here, I've got his brains. It would be nice to hang on to him for a few more minutes and get a few more thoughts for you, for our viewers. Negative gearing. Now, we spoke about investment properties. I suppose in a lot of cases, people either call it negative gearing or positive gearing. Maybe we can just focus on negative gearing for a start. Do you see there's a good advantage for someone building their wealth through negative gearing?
Paul, negative gearing stems from the negative and gearing. Negative being minus, I'm running at a loss, and gearing is the debt. So the debt is, and paying the interest on the loan is what makes it negative. Rental properties are typically a profit and loss, where the income is the revenue earned, and the expenses include council rates, water rates, insurance, repairs and maintenance,
property management
fees. Body corporate strata levies. So once you subtract the expenses from the income, then the interest gets subtracted as well. You find yourself running at a loss. So because of the gearing, because of the debt, it becomes negative and it's a loss. The excitement for a lot is that the loss is then tax deductible in the taxpayer's tax return, of which decreases their income and decreases their tax and generates a tax refund. That's the basis of negative gearing. And
the savvy investor is going to get that refund and put it back into their investment account to help them for the next 12 months?
You should do. The refund, the loss will generate a tax refund at your marginal rate. So if you've got a $10,000 rental property loss and you're in the top marginal rate for income tax, 47% of $10,000, you're going to have a refund for $4,700. So there's $5,300 that you actually haven't got. It's walked out the door. And this is before depreciation, etc. And the only way to get that $5,300 back really is for the property to increase in value.
And that's what we all hope. And we were talking, Ingrid and I were chatting in the earlier part of this conversation about property, and we really believe the market's had a pretty challenging time over the last 10 years, pretty much since the GFC. However, we see there's some green shoots, and we believe the market's going to be on the upward swing. As we speak now, we only had a report from REWA the other day saying that the market is showing signs of recovery and signs that it is actually moving in the right direction. So that's where a lot of owners would be relying on the fact that yes, they've made a loss, so they're negatively geared. They've made a loss, but gee, if their $400,000 property went up by, let's say, 5%, therefore they've added another $20,000 worth of equity to their property. Correct. So that would sort of outweigh that fact, well, I've lost a bit here, but in actual fact I've gained. So when the market's going up, everything looks good. But of course, over the last few years, the market's been pretty challenging. And some people have been saying, what am I doing? You know, like, why am I investing in property? But reality is that it goes in cycles. And Ingrid and I were chatting about the cycles. Those cycles are normally 7 to 10 years or so. And if people hang on for the long term, of course, that's where they make their wealth out of property, don't they? If they have it for more of a lifetime.
I think the long game on property, Paul, was definitely the preferred.
Excellent, excellent. So now, I went to a seminar the other night and they spoke nothing about negatively geared properties, but what they spoke about was positively geared properties. And it was really interesting listening to the presenter talking about that, and it sounded all too good to be true that you could get these positively geared properties. Do you have any clients that have positively geared properties?
Definitely. Positively geared properties, you should probably take, well, the word gear is still okay, you can still have debt, but the debt might be minimal compared to the rents, and the positive meaning that the properties run at a profit at the end of the year. So the profit and loss is still prepared. There's rental revenue minus the expenses, and you're left with a profit. Unlike negative gearing, that profit goes into your tax return, it gets added to your other income, and you pay tax on the profit. Okay. Now this is quite upsetting for some because they don't like paying tax, but I would prefer to have 10 rental properties making me $10,000 a year each and pay my tax, rather than 10 properties losing me $10,000 a year and getting a deduction for 47 but losing 53,000.
Yes, yes. Yeah, but if the market's on an upward swing and it's actually moving, I suppose that sort of outweighs that sort of emotional loss, I suppose. And
well, the values across the board will increase whether they're geared or not geared.
Yes.
It's just a matter of your debt. So older clients with older money and been in longer generally have less debt, end up owning the property, and are positively geared.
Okay, excellent. Well, that's some great advice. Now, the interesting thing with positively geared properties, and everyone says, find me a positively geared property because then I've got cash flow. What we normally find with positively geared properties is they normally have low rates of growth. So they might be in the country regions or the more external sort of regions from the metropolitan area, and their growth rates are quite low, but their cash flow might be a bit higher. But what we do find is when they're in the country areas and their growth rate's low, is we find that sometimes when a tenant vacates that property, it's hard to get another tenant because the country areas don't have the demand like the city. They don't have the schooling possibly, or the shopping and the infrastructure that, obviously the more hot spots where people rent are. So yeah, look, some great advice I think today from Steve. And look, thank you so much. It's a real privilege to have you come in and share with us on our information video to our clients. And thank you for taking the time to be with us today.
Paul, thanks very much for having me today.
My pleasure.